Well, good morning and welcome to today's meeting of the SEC Small Business Capital Formation Advisory Committee. I call this meeting to order. I want to extend a warm welcome to everyone, including a couple of new committee members who will be introducing themselves shortly. And thank you to everyone who pivoted yesterday due to the weather as this meeting went virtual from originally being in person. So it's nice to see you all here on this virtual meeting. And since we were not able to meet in November due to the government shutdown, which means that it's been almost 8 months since we were last together. So please, as much as you can today, have your cameras on as much as possible and engage in our discussion so that we can have a robust conversation about the important topics that we are covering today facing small businesses. And of course, I appreciate members of the public who have tuned in to watch the meeting on sec.gov. Courtney, do we have a quorum for this meeting?
We do, Marcia, have a quorum, and while I have the stage, I just want to give the SEC disclaimer for the meeting. So any SEC staff that speak today, any of the views that are provided are in the speaker's official capacity at the SEC, but they won't necessarily reflect the views of the commission, the commissioners, or other members on the staff. Thank you, and have a great meeting.
Excellent. Thanks so much, Courtney. So just to give a brief overview of our agenda, our meetings frequently focus on ways to expand access to early stage capital raising, and today's meeting is no exception. In the last meeting, we finalized recommendations on Reg A aimed at facilitating more capital formation pursuant to Reg A, and we also started a robust discussion on finders, which we will be continuing today. Now, as a reminder for folks who are tuning in who may be new to this topic, finders refer to the concept of an individual who may identify or even solicit potential investors, helping companies, typically early stage companies, find capital in the private markets. So finders are effectively unregistered matchmakers, helping to bridge a funding gap. They are not registered broker-dealers. So with that said, we know that finders do exist. However, we believe they are fulfilling, in many instances, a necessary function for certain founders and businesses that otherwise struggle to identify sources of private capital and more or less operate in the shadows because there's regulatory ambiguity over whether or not the services these funders provide is compliant from federal securities law perspective. So today, we will continue our committee discussion of finders and continue exploring potential principles, frameworks, conditions, and safeguards that could permit certain finders to engage in limited capital raising activities. And I am hopeful that we can reach an agreement on formal recommendations regarding finders during our meeting today. Then later this afternoon, I'm excited to shift gears and start tackling a new topic, the rise of the private secondary market, including how it is interacting with the IPO market. I think that understanding of how the IPO and M&A markets have shifted in recent years and how the private secondary market has grown to fill liquidity needs and meet investor demands is essential to informing how we as a committee can best advise the Commission on capital formation, including the interplay between private and public markets. We will hear from 3 different industry participants who are experts in this space to better understand the data, deal flow drivers, trends, opportunities, and challenges that stem from the growth and normalization of private secondary transactions. And I anticipate that this afternoon's conversation will provide insights into small business capital formation challenges that we may wish to consider and further hone in on during future committee meetings. I know I have a number of questions, and I'm really looking forward to exploring that during the meeting this afternoon. But before we dive into today's packed agenda, I am so pleased to have Chairman Atkins and Commissioner Peirce joining us. Commissioner Ueda is not able to be with us live due to an unavoidable conflict, but he was kind enough to record some remarks on these important topics. So, Chairman Atkins, I will turn the floor over to you. Thank you for being
great.
here.
Good morning, ladies and gentlemen, and thank you, Marcia, for helming the committee here and leading the discussion for the day. And so welcome to our first committee meeting of the year. And I want to start by saying how glad I am that we're able to reconvene, if only virtually, after the government shutdown, as Martha said, forced us to cancel in the fall. So that disruption only reminded me about how valuable this forum is, because I've long believed that involving industry practitioners in the regulatory process makes government smarter, more responsive, and less burdensome. And in fact, your contributions bring both rigor and market insight to the SEC's role in facilitating capital formation. So I'm really grateful that this committee can return to its regular cadence, and thank you all for your flexibility in light of these wintry weather conditions here on the East Coast. So in just a few moments, the committee will build on a discussion that it began last summer regarding a regulatory framework for finders. As staff of the Division of Trading and Markets emphasized at our previous meeting, identifying potential investors remains one of the most persistent challenges for small businesses, especially those seeking capital below the range that typically attracts investment from venture capital firms or from registered broker-dealers. Regulatory uncertainty only compounds those barriers by deterring individuals from serving as finders and companies from engaging them. The perspectives. Oh, I'm getting feedback. The perspective shared at our previous meeting underscored the need to address ambiguity in the space, and I look forward to hearing the committee's recommendations on how we might foster greater clarity. And later this afternoon, the committee will turn to the private secondary market and its increasingly critical role in meeting liquidity needs. As more firms stay private, two related pressures have intensified. First, demand for investment opportunities in private companies and the need for liquidity among existing investors, especially early investors and employees for whom compensation includes equity. Several platforms have emerged to address these pressures, but I understand that our existing regulatory framework has, in some respects, made that work challenging. Many privately issued securities remain restricted from resale under our rules, or at least for a period of time. Issuers may also impose additional transfer restrictions to maintain visibility into their shareholder base. Layered atop of these frictions is the further complication that secondary trading of private securities is almost always subject to state blue sky laws. Individual investors can sometimes navigate this patchwork through the so-called manual exemption, which generally permits secondary transactions of securities listed in the designated securities manuals, thus the name manual exemption. But complying with state manual exemptions can be costly and time-consuming for both investors and issuers. Of course, this committee has examined state blue sky laws before. Last year, it recommended that the commission preempt state blue sky laws for off-exchange secondary trading in companies that make available robust, publicly accessible, and timely public disclosures, such as those required by Regulation A Tier 2. That recommendation reflects a sound instinct, as many of the limitations on secondary trading in private markets are designated to protect investors. Private companies generally do not provide ongoing disclosures, which means that investors are not as easily able to make a reasoned investment decision. One way to address this, as the committee's recommendation recognized, is to consider allowing secondary trading in companies that provide some sort of ongoing disclosure. Of course, that approach would not necessarily resolve the separate issue of company-imposed transfer restrictions beyond what current law requires. So, more structurally, another way to overcome these concerns is to encourage larger, later stage private companies, the kind of companies that historically would have undergone an initial public offering earlier in their life cycle, to again go public sooner. Which brings me to a broader point and to my priority to reinvigorate an IPO pipeline that has diminished by roughly 40% in recent decades. As I recently testified before Congress, this trajectory tells a cautionary tale that the SEC is working to rectify. First, by re-anchoring disclosures and materiality so that investment decisions can turn on economic signals rather than on regulatory noise. Second, by depoliticizing shareholder meetings and restoring their focus to significant corporate matters. And third, by allowing public companies to have litigation alternatives so that we shield investors from the frivolous, so that we shield innovators from the frivolous and investors from the fraudulent. So with that context, I'm grateful that we will be hearing from a distinguished group of guest speakers to continue our discussion on finders and to begin exploring the private secondary market. This committee's insights, rooted in the real-world experience of its members, will be essential in enhancing capital formation for America's small businesses. So thank you all once again for your continued service and for the thoughtful guidance for us that you provide. I look forward to a productive and engaging meeting ahead. Thank you all very much.
Thank you so much, Chairman Atkins. Appreciate those comments. Commissioner Peirce.
Thank you, Marcia, and welcome to the new members. Good morning to the rest of the committee as well. I appreciate the work of the committee and the willingness of experts to share their views as panelists. I also appreciate the work of the Office of the Advocate for Small Business Capital Formation in supporting the committee's work. I commend the committee for its continued focus on finders and look forward to any recommendations that the committee develops. As I mentioned at the last meeting, current activity in this area is shaped by a muddled web of no action letters that is out of step with practical realities. Last meeting's discussion of status quo finder activity underscored that point. The absence of a finder's framework does not deter bad actors. Good actors may unwittingly act as finders, or if they are aware of the law's unduly strict limitations, may simply observe from the sidelines rather than helping to match investors and companies. I appreciated your in-depth discussion of what sensible finders regulation could look like and your focus on how finders can help companies to raise money in amounts too small for brokers to bother with. You covered a lot of other territory as well, from essential disclosures for finder activity to AI agents. And I hope that today's discussion will be equally interesting and constructive as you devise recommendations. This afternoon, as you heard, the committee will discuss an increasingly mainstream area of our capital markets, private secondaries. The growth of these markets from $162 billion in total volume in 2024 to $240 billion in 2025 makes today's conversation timely. I would be interested in hearing what today's panelists think is in store for the remainder of the year. Will the trend continue? Some of the growth in private secondary markets may stem from an IPO market that, while showing some promising signs of activity, is still not where we would like it to be. Private market investors increasingly are able to turn to secondary markets to exit certain positions and reallocate capital. While beneficial to investors looking for an exit, the flexibility provided by private market tools such as continuation vehicles diminishes the pressure on companies to IPO. As I expect we'll hear from our panelists today, secondary markets are developing to accommodate a wide range of demands that are met by liquidity providers that specialize in a range of transactions. If capital for companies and liquidity for investors and employees are available privately, why take on the burdens associated with being a public company? As this panel discusses the secondary markets, I would appreciate hearing to what degree activity in this space trades off with initial public offerings and what factors investors and issuers consider when deciding which path to pursue. Though I'm happy to see capital formation occur in either the private or public markets, I am aligned with Chairman Atkins' goal of revitalizing our IPOs. Our public markets have benefits that simply cannot be recreated privately. The Commission can do more to improve liquidity in our private markets, but public markets facilitate price discovery and retail access in ways that the private secondary markets can't duplicate perfectly. One long overdue change that the Commission staff recently made has allowed closed-end funds investing 15% or more of their assets in private funds to sell to non-accredited investors with no minimum investment amount. Has this change been apparent in the marketplace, and what else could the Commission do to improve efficiency in and retail access to these markets? Regardless of what we do to expand retail access to private markets, most retail investor portfolios are likely to be concentrated in the public markets. When companies remain private longer, those public investors miss out on the opportunity to fully appreciate the growth of companies that in the past may have occurred after those companies went public. While I'm heartened to see markets develop solutions to capital allocation problems. The rapid growth of the private secondary market signals the need for earnest efforts to enhance the palatability of our public markets. And I'm glad Chairman Atkins is embarking on those efforts with the Commission. Thank you and have a productive meeting.
Thank you so much, Commissioner Peirce. And now we'll move to Commissioner Ueda's remarks.
Good morning. I regret that I cannot be with you in person today. Today's meeting is the first one since the departure of Stacey Bowers, who served as the advocate for small business capital formation. I'd like to acknowledge her contribution to the efforts of this committee. Now, before delving into today's agenda, I would like to acknowledge some recent work by our staff. The first is the 2025 staff report from the Office of the Advocate for Small Business Capital Formation. This report provides a comprehensive snapshot of the state of small business capital formation, including a wealth of information on crowdfunding, Regulation A, and Regulation D offerings. The second item is to highlight work by the Division of Corporation Finance's Office of Small Business Policy to provide much-needed regulatory guidance for small businesses. During the Biden administration, the SEC expended tremendous amounts of staff resources focusing on environmental, social, and political projects that had a weak, if any, nexus to the financial markets, rather than focusing on capital formation. Division leadership since then has refocused on its traditional work on capital formation and investor protection, particularly with respect to smaller businesses. Recently, SEC staff published frequently asked questions on Form D. Since Regulation D plays a significant role in capital formation for U.S. small businesses, we should continue to improve clarity and predictability for issuers seeking to rely on that regulation. These FAQs consolidate existing guidance and are designed to be a one-stop shop to quickly address frequent questions posed to the staff about Form D. The Division of Corporation Finance has also published new compliance and disclosure interpretations, or CDIs, including ones that address new questions about Regulation D. For example, one CDI clarifies that when taking reasonable steps to verify accredited investor status under Rule 506C, issuers can use different verification methods for different purchasers in the same offering. Some of the changes update our guidance to reflect the adoption of new rules and their impact on issues such as transactional integration. Other CDIs formalize long-standing interpretive positions. For example, under Regulation Crowdfunding, the staff described how to switch from one crowdfunding platform to another before making a sale. Additionally, the staff advised that certain guidance and relief specific to registered companies also applies in the Regulation A context, such as extending the non-public filing and review accommodation to Reg A issuers. Lastly, the staff answered certain offering questions that come up periodically in the Reg A space, such as a company cannot accept any money or other consideration before qualification. Our staff stands ready to provide additional guidance and interpretations. If you have questions or believe that additional guidance is needed, I encourage you to reach out to them. Turning to today's agenda, I am pleased that the committee will continue its deep dive into the topic of finders. A regulatory solution in this area is long overdue. A key consideration is whether the regulatory burdens can be minimized given the limited role such persons play. Sound regulatory practices recognize that rules should be appropriately tailored to the specific risk being addressed. If an intermediary serves in a limited role, such as simply providing introductory services, the full range of broker-dealer regulation would not appear to provide additional investor safeguards. Instead, they can deter useful and productive capital formation efforts. Thus, we should consider what regulatory requirements, if any, are so fundamental that they should be applied irrespective of the limited transactional role of finders. These rules are likely to encompass only a small fraction of the broader SEC and FINRA rulebooks applicable to broker-dealers. So thank you to all the participants, the presenters, and attendees for joining us today. Have a good meeting.
Thank you for those remarks, commissioners. We really appreciate your time and your thoughts today. I also want to take an opportunity to welcome our two newest members. So we'd love for you to give us a few minutes to share your backgrounds and to maybe give us some topics and issues that are related to small business capital formation that you'd like to see the committee address. So first, I'd like to welcome Claire McHenry, who is our new non-voting member appointed by the North American Securities Administrators Association. Go ahead, Claire.
Thank you very much. And I appreciate the opportunity to participate in this advisory committee. As you mentioned, I'm the Deputy Director of the Nebraska Department of Banking and Finance, Bureau of Securities, and I have over 20 years of state securities regulatory experience in a variety of capacities, from an examiner to working on investigations and enforcement to areas of policy work. I've also been active in the North American Securities Administrators Association, which is a nonpartisan organization of all U.S. state securities regulators, Canadian provinces and territories, and Mexico. And I'm currently serving as NASA's Corporation Finance Section Chair and your state representative. As far as issues and topics to be thinking of, Finders has clearly been on as a topic of consideration and discussion for NASA and its members. Also interested in other types of education and outreach that we can have to our small businesses to inform them about their capital raising opportunities available to them.
Great. Thanks, Claire. Welcome. And now I would like to also introduce and welcome Joe Shearer, who is the new observer appointed to the Financial Industry Regulatory Authority, or FINRA. Go ahead, Joe.
Hi, Marcia and everyone. Thanks for having me here. I'm really looking forward to being part of the committee as an observer. As Marcia mentioned, I work at FINRA, which is a non-governmental regulatory membership organization that focuses on regulating broker-dealers in the securities industry. I've been with FINRA for over 25 years in various roles. My current role is pretty relevant to the work of this committee. I oversee two teams: an advertising regulation group that looks at marketing materials that broker-dealers use, and I oversee the corporate financing team, which is a complementary team to the SEC's corporate finance division. We do work that's a little bit different from the SEC, and we focus on compensation and conflicts in the public offering space, but we also do a review of private securities that are filed with us for review, sold to retail accredited investors by broker-dealers. So particularly interested in the work of the committee overall. As Claire mentioned, we're interested in the Finders space and all things that relate to securities business conducted in the U.S., educational content as well, secondary trading. But at the core of what we do is making sure that our members are complying with our rules and serving the public in a way that protects their interests, the investors, and the market's integrity, which is our core mission. But again, thanks for having me, and looking forward to being part of the committee.
Thanks so much, Joe. Welcome. And this meeting is Donald Baird's last meeting for serving on this committee after 4 years. I see that he's on the call today, and thank you so much, Donnell, for your service and for being with us today. So as I mentioned at the onset, today we are going to spend the first part of the meeting continuing our discussion on Finders and regarding the role of Finders raising capital at the earliest of stages. So just to give you a little refresh of what we did back in July, we spent significant time laying the groundwork for what I hoped will become a committee recommendation for Finders. So we heard from SEC staff from the Division of Trading and Markets, who provided historical and regulatory context for the Finders issue, focusing on the Commission's 2020 proposed exemptive order, which was never finalized. That proposed exemptive order contained a two-tiered limited conditional exception from broker registration for Finders who assist companies with raising capital in private markets from accredited investors. We also heard from Gary Ross, an attorney who identified that he believes to be a he believes that there is a structural mismatch between early stage capital needs and the existing broker-dealer ecosystem. And he emphasized that broker-dealers are generally unwilling to engage in transactions below a certain size threshold, leaving founders raising lower amounts without professional fundraising assistance. And we also heard from Kelly Arena of Golden Hour Ventures, an individual who considers herself a network builder focused on access and inclusion, who emphasized that many effective connections between founders and investors occur outside formal transaction-based compensation structures. So following the presentation, we had a lively and informative discussion about the practical necessity for finders and the risks created by regulatory ambiguity. We talked about the nature of finders' activities, the differences on a Tier 1 and Tier 2 approach, and many of us felt that the Tier 1 finder approach, it was, there's so many restrictions that it didn't really make sense. And we debated proposed limitations on finder activities, including whether finders should be able to participate in valuation discussions, conduct due diligence, assist with pitch materials or marketing materials, solicit investors, and negotiate on issuers' behalf. We also discussed potential limits on compensation, the need for disclosures about the finder's relationship to potential investors, and whether there should be some sort of mandatory notice filing for individuals acting as finders. So I would say that a number of themes emerged from our prior discussion. These were not recommendations by any means, but they were places that I felt the majority of the committee was united in its thinking on the topic of finders. So first, there is something to be said for regulatory uncertainty itself being a kind of market harm, and the absence of regulatory certainty can discourage reputable participation while enabling bad actors. So essentially, there are people out there who could be the good actors that not necessarily going to participate because they don't have the regulatory framework to do so. And second, we established that early stage capital markets seem to lack appropriate intermediaries, particularly from small capital raises. And there were points echoed not only by the presenters, but by several committee members. And also, as a general matter, many of us do believe and experience that finders often provide value simply beyond introductions and include market insights, investor preparation, and signaling credibility. Many of us also believe that some regulatory framework is necessary and that framework would have to be flexible given the range of finder-like activity from compensated professionals to unpaid community connectors. So with all that background, I'd like to introduce our first invited speaker of the day, Stephen Jafarsova. Stephen is the Chief Compliance Officer and Partner at Stonehaven. Stonehaven is a fintech platform, a registered broker-dealer that supports independent investment bankers and placement agents. So Stephen, thank you for being here. If you could explain the kinds of activities and transactions the broker-dealers at Stonehaven are involved with, and maybe a little bit around the sizes of the types of deals that you do, and your views on the relative advantages and disadvantages of a limited finder exemptions. We'll have you speak for maybe about 7 to 10 minutes, and then we'll take some questions.
Okay, thank you, Marcia. Good morning to everyone.
Well, you're a little hard to hear.
I'm sorry. You able to hear me now?
There we go. That's a little bit better. Yes, thank you.
Okay, thank you. I'd like to thank Chairman Atkins and Commissioner Pierce, and of course the SEC Small Business Capital Formation Advisory Committee members for giving me the opportunity to speak with you today. It's a true honor. I'd also like to extend my gratitude to TJ Special Counsel, the SEC's the advocate for small business formation, and to Stacy Bowers, former director of the SEC's Office of the Advocate for Small Business Capital Formation, for their invitation to speak today. So one of the primary reasons that I'm here today is to try and shed some light around the discussion of finders, which in our context are considered intermediaries who introduce potential investors to companies or private issuers seeking capital, typically operating through private placements. I recall watching the Small Formation Advisory Committee meeting that took place back on July 22nd this past summer, and the discussion around finders seemed materially uninformed to me, not just to me, but to many of my professional peers that viewed the meeting discussion as well. Given the fact that this committee is charged with making certain policy recommendations to the SEC and Congress that specifically impact small business capital formation, I think it's critical to ensure that all members of the committee are well versed in the mechanics and the regulatory framework which has governed the current and historical ecosystem for private issuers and capital formation. And so I'd like to provide a more complete perspective of that ecosystem today through the lens of a seasoned market practitioner that operates directly within that space. I've been serving as a CCO for a small firm broker-dealer and member firm, FINRA member firm, for approximately 20 years. My firm has been purely focused on raising capital for private issuers, facilitating M&A activities, and brokering large private secondary transactions. I'm also a member of FINRA's Small Firm Advisory Committee appointed to this position by the FINRA Board of Governors. And I am also a chartered alternative investment analyst and certified regulatory and compliance professional as designated by the FINRA Institute at Wharton. So I've spent most of my career advocating for smarter regulatory policy for small firms. And that is why today's topic of finders is so important to understand holistically. In fact, my partner and the CEO of my firm, David Frank, and I co-authored a letter to the House Financial Services Committee last year, of which a copy, I believe, was provided to the committee members ahead of our meeting today. And this letter really goes to the heart of both capital formation and investor protection, and it focuses on the Unlocking Capital for Small Businesses Act of 225, a bill that has yet to be introduced to Congress. We've all seen rule promulgation and policy initiatives which are well intended, but if implemented would have widespread and negative unintended consequences. I believe that this bill is a prime example of this. And I think it's fair to say that we all want to expand access to capital for America's small businesses, as they are the backbone of our economy. They drive innovation, create jobs, fuel economic opportunity in communities across the country. And as a firm that has raised more than $11 billion in private capital across all sectors over the past 20 years, we're deeply committed to responsible capital formation. But it's key to note here that capital formation and investor protection are not opposing forces. In fact, they are mutually reinforcing pillars of healthy markets. And it's precisely because we believe in expanding access to capital that we oppose the act and certain elements of the finder's exemption that's been proposed. The proposed legislation seeks to create a broad federal safe harbor for so-called finders, exempting from broker-dealer registration under certain thresholds. And transaction-based compensation under $500,000 annually, capital raises under $15 million per issuer, or under $30 million total, and fewer than 16 transactions per year. And while these limits may appear modest, I want to convey that the implications are not. The broker-dealer regulatory framework administered by FINRA and under SEC oversight is critical to maintaining healthy and trusted markets within the U.S. It's a time-tested system of guardrails that protects investors, ensures market integrity, and fosters trust in private markets. Weakening this framework risks eroding the very foundation upon which sustainable capital formation depends. And so I want to briefly summarize 5 major points regarding the Act and its proposed finder that we reference in our letter that I noted earlier. First, let us consider due diligence and suitability. Under existing rules, FINRA registered broker-dealers must conduct comprehensive due diligence for private placements. They must review financials, analyze models, assess risk factors, and ensure disclosures are fair and balanced. Registered representatives must satisfy suitability standards and act in the best interest of their clients under best interest, also known as Reg BI, which is oriented towards retail investors, which ironically is the exact demographic with whom these so-called finders would be engaging. These are not abstract or excessive requirements. They are operational obligations backed by supervision, documentation, enforcement, and public transparency through BrokerCheck. The proposed finder exemption would remove these foundational safeguards. Individuals receiving transaction-based compensation, arguably the defining characteristic of broker-dealer activity, would be permitted to operate without the license, education, supervision, AML, and standards required of registered representatives. Private placements are inherently less transparent and more illiquid than public securities. They involve limited disclosures, and limited liquidity. That is precisely why I believe robust oversight matters most in private markets, not least. Without broker-dealer oversight, there would be no structured due diligence framework, no suitability review, BI outlining conflicts critical to making informed decisions, and no meaningful supervisory system ensuring fair and balanced communications. The result would be predictable, an environment that may attract some well-intentioned actors, but one which would also attract a spectrum of bad actors seeking to exploit regulatory gaps and focus on personal gains.
Hey, Stephen, we have about 5 more minutes for your remarks. So if you could.
Okay, I'll try and summarize and tighten up a little bit. Thank you. Second, let's consider marketing and communications. They must be fair and balanced. Interest and compensation must be disclosed in the framework. Proposed act, these protections would be materially loosened. Finders could distribute promotional materials without principal review, without the same disclosure standards, and without a supervising broker-dealer accountable to regulators. Third, let's consider anti-money laundering and record keeping. Broker-dealers operate under rigorous AML, customer identification programs, and record retention requirements. These systems create transparency and traceability. They deter illicit actors from exploiting private markets. Reducing these requirements and ecosystem increases the money laundering, market manipulation, opaque transactions that are harder for regulators to monitor. And this would erode market integrity and trust. Fourth, let's consider investor recourse in scenarios where they're harmed. We have FINRA's arbitration forum for investors who suffer harm from broker-dealer misconduct today. FINRA has enforcement authority to investigate and discipline member firms and reps. BrokerCheck provides public transparency. Under a finder regime, what recourse would investors have? What would prevent individuals previously barred by FINRA from reemerging as finders? How many investors evaluate, or how would investors evaluate track records without public disclosure systems? Removing participants from FINRA's jurisdiction does not eliminate misconduct. It merely shifts it outside a structured enforcement framework into an already overburdened civil and criminal. And fifth and final, let's understand the Act's risks created creating an unenforceable boundary between regulated and unregulated markets. Finders would self-monitor compliance with compensation thresholds, capital raise limits, and transaction counts. There would be no centralized oversight body tracking when these thresholds are exceeded. The incentives are obvious. Why remain under a supervised broker-dealer structure if one can operate under lighter oversight until thresholds are crossed? And who ensures that thresholds are accurately reported when they are crossed? Over the past 15 years, a modern regulatory platform model has emerged. Small broker-dealers act as umbrella compliance and infrastructure hubs supporting independent contractors, often solo practitioners who raise capital for private companies and funds. These firms provide licensing, supervision, AML systems, marketing review, due diligence processes, contracting, much more. Firms don't one of these regulatory platforms.
Hey, Stephen, your audio is starting to cut out. Thank you for those remarks. Robert, you had your hand up?
Yeah, so I don't know how to put the hand down, but there we go.
It's okay.
Yeah, so Stephen, I'm the National Ombudsman. I oversee regulatory enforcement by all federal agencies against businesses, not-for-profits, cities, counties, and towns. Definitely appreciated the message. What I feel is missing is this does occur. We have finders. I've founded and run a business, and I've also taught at Georgetown University. I worked in their entrepreneurship department. Finders are everywhere. They're an absolutely crucial component of the small business ecosystem. And while I definitely appreciate FINRA, there is a gap in that market we're seeing filled. So the point here is to put in some guardrails and ensure it's clean, above board, and can be regulated. without pushing that entire burden onto small entities or to people who would not otherwise be considered broker-dealers.
Appreciate your comments. Yeah, I don't disagree with you there. However, we do agree on that there should be a reasonable framework of oversight in that lane. And I think that the current ecosystem, the current regulatory framework really provides exactly what is needed. And it's a very simple, cost-effective pathway to become a registered rep and join a broker-dealer. I think that really the issue here, it's a problem seeking a solution. The framework's been in place for quite some time, and it's been functioning very well. We've got 150 individual registered representatives on our platform. We're well aware of scores of other broker-dealers that do the same. And keeping everything above board in our mind is paramount to market integrity and to protecting retail investors, which are at the lower end and would generally be touched by finders.
So, Stephen, your firm will actually help companies that are looking to raise maybe $1 million, $2 million at reasonable fees?
That's correct. We support a broad range of private issuer clients. Some are looking, to your point, Marcia, for small capital raises, sub $3 million in safe rounds, et cetera. And we go up to larger Series D and E rounds that may be $50 million plus, raise money for the fund, and we M&A activity as well.
Mm-hmm. And what about people who are raising less than that, like 100,000, 250?
I think that there are Reg CF speaks to that, micro rung of the ladder there on very small capital raises for. I think that the crowdfunding aspect of the rule really touches on that.
All right, Rose, then Bart, and then I thought I saw Robert again, but Robert, if you want to chime in after Bart. Rose.
Sure. I had a question because, it's not just retail investors, right? If a small business is raising, let's call it 100,000 or 500,000, they may want to be connected to high net worth individuals, angel investors, and it wouldn't be a Reg CF given the limitations on any one individual's investment. Does the regulatory framework work for those companies to use a registered broker-dealer in a cost-effective way? And, there's instances that we have heard where a small business may try to engage a broker-dealer. And I think we heard in some opening remarks from the commissioners, it's really too small for a registered broker-dealer to deal with. They don't want to be bothered with something that small. What do you think is a solution for that gap?
I disagree that certain broker dealers would be bothered or they would not be interested in supporting the private issuer and assisting them in raising capital. I think it really depends on the opportunity and how compelling that opportunity is. The market will speak as to whether or not it is a compelling opportunity or not. And so I think that, on the smaller end of the scale for raising capital, if folks do want to get into that lane, they don't need to stand up their own broker dealer. It's not the cumbersome pathway that may be a misnomer here. They can join broker dealers that support individuals and who are trying to source and sell private investment opportunities really at any level. And I think a lot of folks on our platform, we have a diverse group of agents on our platform. Many are focused on the smaller end of the market, some on the micro end of the market, and others are focused on larger scale opportunities as well. So our focus is really on market integrity here. And I think that, although well-intended, when thought through and looked at through a holistic lens, certainly from a seasoned market practitioner, from my own perspective, I think that that creating this lane, I mean, you could imagine if everyone's got a driver's license out on the highways, right? And if we were to say, hey, for those people who are not who are driving less than 100 miles a year, you don't need a driver's license. Those folks are still out in the lanes with everyone else driving. They're not held to the same standards. It could cause a lot of really negative unintended consequences. And I think that analogy is really pertinent here.
Marcia, if I may, can I have a quick follow-up? So I'm not sure that the last analogy works. I think this is more somebody can drive on their own farmland versus on the freeway with everyone else. I want to go back to something you said early, which is, the compelling opportunity, right? So the small dollar, the broker dealer won't, you believe they'll be willing to engage even at a low compensation with the high regulatory burden if it's a compelling opportunity. My concern there is, are we truly putting the broker dealers in the gatekeeper role as to which companies can or cannot go outside their networks to raise, whereas we're talking about small companies that need network effects to find not just retail investors, but potentially accredited investors. In most cases from our conversation, it was accredited investors. Again, really different than going to a retail investor or a Reg CF situation.
Well, I think that there's already SEC Rule 3A4-1, commonly known as the issuer's exemption. So the private issuer itself does not need to become registered to go out and raise capital for itself. That's been in place for some time now. But if you are utilizing intermediaries and agents to assist you in raising capital, I think that there's a lot to look at from the downside, and that needs to be weighed responsibly against the upside. And so my contention here today was really to brightline a lot of what could occur on the downside of creating this lane without critically thinking through the frameworks that have been in place and have been functioning for decades.
One last question from Bart, and then we'll have to move on.
So drilling down to that a little bit more, could you maybe provide a little bit more context on what the costs associated with using a broker are? And then if you have any information on what the average size of raise that a broker did, that might provide some context. And specifically, some of the backdrop here is from some of the folks that we heard before, the finders that we are talking about are often not full-time professional broker dealers whose primary day job is connecting folks, but generally going to be folks that do this somewhat tangentially to some of their other activities. And usually it's connecting issuers with their own personal networks of potential investors, which tend to be accredited. So it's a more sophisticated class of investors. And I'm curious because I think your proposition is that those intermediaries should go through the work of becoming a broker dealer or operating under it. And if you could provide any context of like what that barrier is, what are the personal costs to those intermediaries? I'd love to hear that.
Sure. Happy to discuss that. I just to clarify, speaking about the economic framework for the private issuer, the economic framework that the agent or the finder would need to look at.
Yeah, kind of both, right? So what is the cost to the issuer? And then, obviously of that cost, how much of that that's going to the broker do they keep versus go into their own sort of like administrative burden on that?
Sure. So I mean, we see market rates fluctuate, and depending upon the size and structure of the opportunity, economics generally on the lower end of the scale are going to have higher percentage fees for raising capital. So just to clarify, there's a commercial element to this, and then there's a regulatory element to it. Just speaking on the commercial element, I don't think there would be much change from a market rate perspective, whether or not the intermediary is a registered agent or not from the private issuer's perspective. To address the second part of your question, as far as what does that pathway look from a cost perspective to an individual who would want to become an agent on a broker dealer? And we have many who are not full-time capital raising agents, but do have full-time positions and do registered work tangentially, and their full-time work is covered by Rule 3270 and an outside business activity that's reported and approved by the broker dealer to engage in that. So there can be all types of profiles that engage in this type of activity, not just full-time capital raising agents. But the pathway is quite simple, at least with Stonehaven and with many of our peers. It's a de minimis level of onboarding fees, generally measured in hundreds or $1,000 in that range. The pathway to getting licensed and registered is not difficult. Tests can be taken to obtain the SIE, the Series 7, the Series 63 in a matter of weeks in some cases, in most cases that I've seen with agents coming on board. So I think that some deliberate, framework is required here, and it's really a simple pathway forward that is cost effective for individuals that do want to pursue that path.
All right. Well, Stephen, thank you so much for your time today. Robert, your hand was up and down twice. Did you have a last question?
Yeah, I just wanted to say nearly 30 years of data this office has backs what Rose and Bart were saying. And Stephen, I'm not sure it aligns with you. It's not the same as driving on a road with everyone else. It would be more like you can drive a golf cart on your own property, and saying, oh, if you want to help connect someone in your town to funding for, in our examples with meat processing, these are $30,000, $40,000 investments. They don't have the opportunity to take a month off of work, study for the Series 7, acquire the necessary materials to ace it, and then execute a single deal. So I just want to make clear what's happening in most of America for an extended period does not align with the model you're proposing. Thank you.
Great. Well, thank you so much today for being here, Stephen, and giving us your thoughts. You are, of course, welcome to watch publicly on sec.gov the rest of the meeting. Thank you.
Thank you, Marcia. Thank you to everyone.
All right. Okay, so that is, we've definitely covered a lot between last meeting in July and what we've been talking about today related to finders. So last night you received an email that included a summary sheet that helps to distill the differences between what we talked about last meeting with the Tier 1, Tier 2 finders, and then between those finders and registered broker dealers. As I said before, we really thought that having two tiers was a little complicated, but we were focusing more on the items in the Tier 2 column. So if you did receive that email last night and you have in front of you, that's kind of what we'll be talking about. But before we go into any detailed discussion, I'm curious to hear from any of the other committee members your thoughts on finders in general and the need for them.
Yeah, I would just say that that some of the points that were raised toward the end here, I do think are material. And there are a lot of raises that are frankly just too small for registered broker dealers, regardless of protestations, otherwise. So I do think that opening up a way for finders to operate and be above board and have guardrails would be superior to the current situation where they don't operate above board and therefore do not have guardrails.
Oh, yes, how are you?
Oops. Diego, I think you're not muted. Okay, Claire, go ahead.
Thank you. So NASA has spoken several times about the issue of finders, including providing testimony before this committee and raising some of the concerns that Stephen has also raised in particular. And I just want to say some of the concerns that we have about finders are not theoretical. we consistently have enforcement reports where we highlight the role that we have in our gatekeeping of making sure that bad actors are kept out of this industry. Also with the types of enforcement actions that we take involving unregistered securities and often the intermediaries that are involved and the fraud and activities that are included in there. So just wanting to highlight for those on the committee who may not be aware of the work that NASA has done, the states have done in this space, I would point them to our enforcement report for 2025, but also that we stand ready to have those discussions with the SEC and with FINRA about creating a more tailored approach to those finders and to get them into a registered pathway.
So you would support a framework that was specifically for finders?
So we have been consistent in our message that we would be willing to have those discussions to have a more tailored approach to those who are engaging in those types of activities, but not a wholesale preemption. For example, on the due diligence front, it seems counterintuitive to us to have somebody who is not even conducting any level of due diligence or a requirement for that to then go and be selling those types of securities to retail investors.
But it happens all the time. Like, I mean, angel groups do their own diligence. They're basically, making decisions for whether or not they're going to invest in a company, and they don't use a broker dealer, and they're not. But so what would really be the difference here?
The difference
Just because
would be
somebody's getting paid.
The compensation is an element to it. The level of opacity to this particular industry is by nature making it difficult for retail investors to get the levels of information that they need. And the intermediaries do play an important role in that respect. And having somebody come in and not having done any level of research on those offerings and then trying to sell it to another person for compensation, I think does change the nature of it.
All right, Herbert, then Bart, then Jennifer. Herbert, I can't hear you. Herbert? How about Bart? You go. We'll get Herbert.
Yeah, so my question is, we keep, there seems to be some level of distinction between what we're referring to as retail investors. And Claire, maybe you can sort of like clarify a little bit more when you're talking about retail investors. Are those unaccredited? Are those casual investors? And maybe more sort of posing the distinction is there a line between some of this bad activity that we're talking about and what I'll just call more sophisticated, accredited investors, folks that are part of angel groups or investor networks that, that for whatever reasons may be more sophisticated. And is there a line of distinction in there that may be relevant to some of this exemption activity?
I think there is some levels of distinction between accredited versus unaccredited. However, as we have since the unaccredited definition has not changed significantly, more and more people can be classified as accredited investors. So there is difference between those who are maybe in an angel position, those who are sophisticated, have a higher net worth, maybe have a little bit more ability to have that access to that information than somebody who only is accredited because of they have accumulated a significant amount of retirement funds, but aren't generally necessarily always in an angel position. So it's part of the discussions that I think could be had about with the SEC and with FINRA about how to craft such a tailored regulatory regime.
Yeah, in our last meeting, we did talk specifically about whatever the finders are doing to help the companies raise. It would all have to be compliant within the offering. Like, for example, if the offering is only for accredited investors, then the finders are only going to solicit accredited investors. We didn't really, I think there's two separate topics going on here. Having a whole conversation about finders helping companies to find accredited investors is one thing. It's a whole other animal to get into finders helping the retail investors. And I think that's a completely different topic. But Herbert, did you get your audio fixed?
Can you hear me now?
Yes.
Can you hear me now? Okay,
Yes.
great. With respect to enforcement issues, do you find that they're about the same with finders and brokers, or more enforcement actions on with one or the other?
Are you asking
I'm
Claire?
Yeah, I'm asking Claire. I'm sorry.
sorry, could you repeat the question?
With respect to enforcement actions, is it about the same with brokers and finders, or you find that there's more enforcement actions on the finder side or broker side?
I would say it's more in the unregistered space. So we do not have as many enforcement actions involving a registered broker dealer who is engaging in private placement activity. It is more frequently in the unregistered intermediary space for unregistered persons and unregistered issuers.
Is that significant? I'm just trying to gauge the depth of the concerns.
It is significant. Typically in finders or in a registered space, we're able to engage in gatekeeping functions. And so that we're able to keep certain bad actors out of the industry from the beginning through our registration and licensing process. That is a strong process that we use to review backgrounds and ensure that persons who should not be in this industry are not in fact in this industry. In fact, in our enforcement report, we also highlight those that we have either who have voluntarily withdrawn because of the level of review that occurs during the registration process, including those that we have denied, suspended, or even revoked their license.
Thank you.
All right, Jennifer, then Rose, then Robert.
Yeah, and this may have already been said, but just looking at the culture of early stage finders, I was just wondering, and I think, Bart, you may already have asked this question, if there was just a way to create a level of distinction between those actors or individuals that are more sophisticated, because the culture of early stage finders are more relational, like what we heard in the last meeting. And it's probably, maybe you're looking at 1 to 2 raises that they're doing on an annual basis. It's not repeating or frequent, and they operate as like community liaisons, where they're working with various startups to try to acquire capital. But if there's really a way to create a distinction between those kinds of activities and then the other actors that are clearly in the business of finding capital and do have the capacity to take a series exam or to engage a crowdfunder, because the reality, the paradigm of early stage startups, there's not a lot of time and a lot of capital around to just just throw it at a Series A. I don't know. I don't even know what the fees are now for those FINRA exams, but it's just sometimes just not feasible. So just I guess that's our discussion today, but just creating some way to create that distinction between the different cultures that we were probably encountering in this issue.
Yeah, thanks, Jennifer. Rose, then Robert.
Yeah, to build on what Jennifer was saying and going back to our prior discussion, I realize it was quite some time ago now. And this was in the prior release too, around permitted activities. I want to make sure that we're clear as a committee who we're talking about, because we are talking about finders who would not sell a security. So I think we did come to a consensus in our last meeting that there are certain activities where it does make sense to have a regulated entity making, doing these gatekeeping functions, because they are passing on the credibility of the offering itself. Where we have not been talking about that when we've been using the word finders, or at least I have not when I look back at the past meeting, right? It's really this connector, right? These are the intermediaries that are not saying, I have done due diligence on this. This is a great investment. You should put your money in it. It's, hey, you should meet Sally, right? I think there's a good connection there for you guys to talk about, her company. And right now this happens all the time, and it's very gray. And I think it is keeping out well-intended actors. And so maybe the reason we're seeing a lot of enforcement there is because we're seeing people that are going to take advantage of that in the market, where the good people are, these are very subjective terms. But so I just want to make sure that we're clear when we talk about recommendations, are we talking about, going back to that permitted activities, do we think there is a line, right? Do we think, okay, you can go here, but not here, right? And how do we monitor if you do these activities and not those activities? Because I do see a distinction. I actually don't disagree if somebody's going to come and say, I have done diligence and this is an offering that you should invest with. I have a lot more heartburn with that being an unregistered, whatever you want to call them, versus, hey, you should meet Sally.
I would agree with that. Robert?
I agree with that as well. And I just want to push back a little bit, Claire, on the notion that by regulating and registering people in this industry, we are effectively keeping out all bad actors. A huge component of the SEC's work is enforcement against bad actors. So you may see a higher report, and I don't have this data, and I don't believe anyone has this data, but you mentioned there'd be a higher percentage or proportion of unregistered broker dealers and enforcement actions against them versus registered. Most people aren't registered, so you're going to see a higher proportion from that. And then the scale at which you're seeing bad actors on the registered side far exceeds that on the unregistered side. Someone who is registered and a bad actor like Bernie Madoff is doing a lot more damage than someone who made an introduction to 2 or 3 people in their town and didn't realize the owner wasn't keeping books properly. So I just want to put that in there as part of the discussion.
Yeah, thanks, Robert. Okay, so not as a formal vote yet, but of the voting members of the committee, is there anyone who is opposed to the idea of finders as connectors, as long as they are staying within the offerings framework of that security that's being offered? Okay, great. And then we had talked about in this case, it's the tier 2 part of the November 20th or November 2020 previous committee's proposal. So in our last meeting, we did talk about what the finders could do and how, I guess there was, like, in my mind, there are like 3 buckets here. What can they do, or what would we say they should be able to do as far as marketing, diligence, being a part of the overall discussions, and then talking about the thresholds. What would we say that how much could they raise? We heard about up to $30 million, 16 transactions a year, things like that. And then also just about how do they even how would it be so that the SEC would even know that they were, how would they register? How would we know that they were a finder, and what would we put them through in order to do that? So maybe we could have a discussion on those points so that we could come to a little bit more of clarity on the actual recommendations that we might want to give to the commission. Rose.
Sure. So I think when we had conversations around the limitations of the past ones that Marcia mentioned, if people have what was circulated before the meeting, since unfortunately we're not there in person before us, I'd be curious hearing from other members as to whether or not the tier 1, tier 2 makes any sense in terms of distinguishing activities and thresholds, or if we want to focus our conversation on, a safe harbor for finders and, really everyone would be under that one safe harbor if we can come to alignment on the appropriate guardrails around that safe harbor. My take is looking, what happened back in 2020 and conversations, there was the prior committee had conversations around that. Obviously that stalled. I think this just adds complexity in an area where we're trying to add simplicity. So I think does the opposite of what we want. And I would suggest that there is, one framework for finders as distinct of registered broker-dealer. I would suggest that it does have, a set of activities that they can do and, with a line. And for me, that line is that due diligence to recommendation. I'm not saying that they can't do due diligence, but not due diligence to the point of making a representation that I have done due diligence and this is a good offering for you to put your money into. And then, I'm curious of people's thoughts of like, if this is a 506B or C offering, do we, expand the check boxes as to whether or not a finder was used? Is there some sort of disclosure to the investors that say, hey, this round was, there was a finder that helped this and they're getting, a 0.5 point of the raise or something like that. But I would really welcome committee members to raise our hand. Appreciate that we're not in person, but we had a robust discussion in July and let's try to follow up on that.
Thanks, Rose. Yeah, agreed on that. And yeah, we did talk in July about the disclosure to investors in some way. Other comments?
Yeah, I agree. I think a disclosure is important, and I think that's where we came down last time. It doesn't feel right for retail investors to make an investment and find out only later that the person who did the introduction personally benefited from that. So I would think that a disclosure would be critical. I guess I also agree that creating 2 tiers it may make us feel better, but I'm not sure it's helping the market. And creating a single tier would probably just be simpler for everyone and make the rules clearer.
Yeah, I'd agree with that. And just to be clear, when you're saying retail investor, that would be somebody who is accredited.
Yeah, I'm sorry. Yes.
Not under an institution. Okay. I just wanted to clarify because, yeah, in the public markets, we say retail investors mean something different. Okay. Yes, I agree with that. And Herbert, go ahead.
I just want to underscore what Rose and Laura just said. Yes, disclosure, yes, and 1 tier, which in this instance would be tier 2.
Mm-hmm. So let's go to the next big topic, which is about thresholds. In some of our one-on-one discussions with the commissioners, I think they would like to see some information or discussion from the committee about where those thresholds might make sense. And this would be the amount of money that a finder could help a company raise, the amount of times they could raise during the year, and then what their maximum compensation could potentially be. So maybe we could talk about that for a few minutes. Bart.
I can at least talk about sort of the type of activity that I'm used to seeing in sort of the venture markets. The range of amounts is, I think, actually pretty big. It is everything from tens of thousands of dollars to millions, a little bit talking about what type of business you're talking about, what sector, what region. Folks trying to raise, money in the Midwest for a meatpacking plant are going to be different than folks trying to raise money for a biotech company in Silicon Valley. So I do think any discussion of a fee-based amount could be difficult because there's such a range. I think number of fees that you paid, I think is a little bit more interesting, because I think the type of finders that we are talking about, this is not their full-time job for the most part. And again, I think it's tough to put firmness around that, but at the same point, once you're in the habit of doing it, it's more than one, which is one of, I think, the big limitation of the tier 1 thresholds. So, just trying to kick the conversation off, at least what I am seeing in the market is that the dollar range is big enough that I don't know that it makes sense to have a firm number there. The number of offerings, I think maybe a little bit more fruitful, something more than 4, but less than a couple dozen, just in my personal experiences, is probably what I'm used to seeing.
Mm-hmm. And I think that was kind of the feedback that we had gotten from the commissioners, that they were interested, not necessarily in definitive numbers, but in at least giving some type of a range of what's happening out there in the marketplace. Robert.
I agree with Bart. If you go off of dollar amount, you're going to see such variance across geographic regions and industries. It's not going to be as effective. Whereas if you go off of number of transactions or something similar to that metric, it's going to be evenly enforced.
Mm-hmm. So would we use a percent instead, or what are your thoughts on that, Robert?
I would think number of transactions would be the strongest.
Okay.
If you're helping 1 or 2 or 3 deals a year, that seems reasonable. I don't have an exact number in mind. What would it be a percentage of the final raise, or?
That's what I was thinking, the final raise.
I would think that making sure that the finder's fee is not predatory would do a lot to keep bad actors out of the space. So if we're concerned about bad actors, if it was me, I would say a limitation of a 1% finder's fee. That may be too draconian, I don't know, but a 10 or 20% finder's fee feels predatory, and it feels like that would attract the wrong people.
I'd agree there. Herbert and then Rose.
I think we moved into talking about number of transactions, and then you blended fees in there. I was going to ask about fees. Typically, when I've dealt with finders, it's been on the called capital, not necessarily the committed capital. So which, 2 different date horizons, if you will. So I wanted some thoughts around that. And this could be, depending on what we do here, we could create a cottage industry. So I think in the context we're talking here, we're talking about a solopreneur or a single man or woman shop. But if someone really leans into this, once they get some guidance, they could have 5 or 6 folks in their shop. And now the transactions could be 10, 15, 20, if you will. So I just want to throw that out there if we're looking to limit the number of transactions.
Mm-hmm. Rose.
Yeah, I agree. And I also agree with, the prior framework said that these would be individuals as opposed to entities. Now, I think it could be, if it's a solo entrepreneur, maybe through their LLC, that's a, single member LLC. Because I do think once you go, and this really goes to the number of transactions. And, I have seen this in the NASA and FINRA enforcement data, right? Once you have a handful of folks that put themselves out in the market, they're not registered a broker-dealer, they're advertising, come talk to us, we're going to connect you to people. I think that is problematic. But if we're talking about connectors and, 3 or 4 connections, think about that as once per quarter, and they're going to get, compensated. They're going to be incentivized to help the capital formation within their networks or within their local communities. Again, it's happening anyways. If we can encourage people to do it in a smart way that is transparent, that's sort of where I come down on the number of offerings. I also wanted to chime in on the range, right? So obviously it's 0, and then what's the upper limit, right? I do think that there should be an upper limit, right? I mean, we have 506C. I know this committee has talked about 506C. It doesn't have a lot of uptake, but that really is out there in terms of general solicitation. So if you're using finders, this should probably be on the smaller side. Now, I would probably go up to, something akin to Rule 504, which I believe it's still 10 million, right? And if it's really a larger raise coming together, maybe there's, separate raises going on, right? Maybe you're getting traction with a finder, and now as a small business, you're able to prove that there's a there to then build on network effects and go out and make a larger raise. Maybe now you have compelling information to do a 506C if you don't have the network. But I think now moving into compensation, I think especially if you have it as a percentage of the raise size. First, I do think it should be a percentage of the raise size. I think you get into a lot of issues if it's a percentage of introduced folks. I have seen in the market a lot of disagreements and disputes happen as to who was introduced. I think it's also hard to tease out if you're able to introduce an anchor investor for maybe that $500,000 check that now brings in another 10 checks for $100,000. That's a real raise, right? Like, did the finder really help that come together? But if we're saying it's a half a point or a point of the total raise size, and now we're going up to 30, 35 million, to me, that gets predatory, right? So I think those two do go hand in hand if we want to set some thresholds around this.
Okay, George, and then Jennifer.
Yeah, so around the kind of number of transactions, I guess I would first like to better understand kind of the level of registration that an investor, that a finder would have to go through. As an entrepreneur, right, we get approached by finders all the time. We always say no, partly because there's no way to check who they've worked with in the past and, are they credible? So if that information is being tracked and there are references available and that type of information, I think there's probably more comfort to allow more transactions. If this really is just kind of a lightweight disclosure and very kind of quiet on the side type of thing, I think we'd have to look at a lower number of transactions. So I think this conversation about number of transactions is kind of closely tied into how are these being documented and how is that finder being registered or accounted for within FINRA or the SEC. The other thing I would just caution against is within the world of fee caps, regulators have historically not been great at setting fee caps. Like we don't necessarily know how these finders might be compensated for these deals. And this committee is about small business capital formation. And the harder a deal is to fund, the more a finder is going to need to be compensated to make that match. So I would just be very cautious about us putting our finger in the air and saying, oh, 1% is good, because I don't know exactly how this market is going to be made.
Mm-hmm. Good point, George. Thanks. Jennifer?
Yeah, that's exactly what I was going to say, George. Just, anytime we're talking about like a hard percentage cap, it just makes it really difficult to encompass all of the variation in this industry. And I'm just thinking of a few of my clients who typically will engage someone who's acting in this role by not only looking for assistance with getting capital, but they're also being compensated for an advisory role or some other long-term role or partnership that they will ultimately engage in. And so the whole compensation structure is designed to really to be responsive to that structure. So it's not so much focusing on or solely based on their ability to bring capital, but sometimes it's tied into some other deliverables that may not come into fruition until later in the in the partnership. So creating that hard cap is sometimes difficult when you have all of that nuance in in this kind of industry.
Yep. Thank you, Jennifer. All right, so I have in front of me the November 13th, 2020 recommendation from our committee from back in that day. And what I'd like to do is very slowly read through what the principal recommendations they were recommending at the time, and as they kind of get a little bit more complicated as we go down, so maybe we could stop and talk if there is something that we don't agree with. Here we go. Number 1. Recommendation is that the framework should be kept simple. I think that's definitely something that we talk about. Jennifer, do you have a question before I go through this? Sorry, your hand was up. I was making sure. Okay, good. All right, thanks. All right, so number 1, the framework should be kept simple. I think we're good there, right? Yell if not. The framework should keep out bad actors. I think we've all said we agree with that. The commission should consider requiring a notice filing for all finders, which includes information on fees charged for finder services. And we may not get to a consensus today at this point about what these thresholds should be or what the fees should be, but at this point we're talking about there should be a notice that the finders file and includes information on the fees that they're charging. Any objection there? No? Okay. The commission should work with state securities regulators to provide additional certainty for market participants with coordination among the states and the commission. And maybe Rose, you could just elaborate with a sentence or two on exactly what that means for those of us that don't work in this all the time.
Sure. I'm going to go back to the prior discussion that this committee had on Regulation A and preemption, right? And we've heard that already. I think we heard that in Chair Atkins' remarks this morning. We've heard that from Claire, right? The states have their own regulatory regimes in addition to what the SEC has and what FINRA works with. I think this is, there should be coordination, especially if we're going to be talking about the transparency that George mentioned, a notice filing, right? Some coordination to make sure there's access to that information getting reported, not just potentially to the SEC and FINRA, but also to the state regulators as well.
Great. So basically there's a transparency. Excellent. Okay, any comments on that? Okay. Number 5. It is important that finders and issuers know the rules of how finders can assist with capital formation for small businesses. Now, I think we have determined this, but then we also took a little bit farther to say, well, what is it that finders can do? I think we talked about that a little bit more in our last meeting than we did today, but does anybody have any comments or thoughts on the things that a finder could or could not do? Because what we did talk about today was how in a lot of cases these finders are connectors and they're trying to help maybe with a pitch deck or try to help to get materials out to potential investors. How do we feel about that?
Okay.
Go ahead, Laura, then Bart.
No, I would say that, if you're not going to be licensed and regulated, then you should not present yourself as having done due diligence on a company and as making an investment recommendation. short of that, I think doing introductions and helping with pitch decks are things that happen in the real world all the time.
That's right.
And should not require licensure. So for me, that's the bright line, is making an investment recommendation and having done putative due diligence, which these people should not do.
Yeah, go ahead, Bart.
Yeah, I was going to basically make the same comment, sort of echoing back to our last meeting. I mean, one of the things that we did here that was limiting from the prior proposed rule was, there's some pretty express prohibitions on no commentary on the pitch deck, no commentary on the terms, and we heard from our previous speakers that was a little too limiting. Totally agree with the conversation that we've had before. I think once we get to a point where you're openly advocating, for a deal or taking the money or directly selling securities, that's gone too far. But we can't go all the way to, finders being able to make some level of commentary.
Right. So could we agree that it's important that finders and issuers know the rules of how finders can assist with capital formation for small businesses, but not make direct recommendations or have, something about due diligence reports and actually, I guess the line lies in the making of the recommendation of the investment, right? We're saying you could help, but you're not going to say, I recommend this investment. Do we all agree on that? I'll agree on that. Okay, great. Number 6, the commission should consider a blanket exemption for finders for offerings under a certain size. So here we're back to the size piece. We're saying we're going to take that out, or we're leaving that in and adding to it? Thoughts?
I mean, this is not holding us to a size, right? I think maybe there's more discovery around what an appropriate size would be, but I conceptually, as a principle, yes, I don't think finders should be allowed to make introductions across the entire spectrum. I think, we have been talking about what's happening in the real world for small businesses in these smaller dollar raises. So I think the recommendation should be tailored, to the problem we have been talking about, which is not the 100 million Series B or Series C of an institutional backed, high growth company. That's not what we've been talking about.
Okay, so we would keep that language the same. The commission should consider a blanket exemption for finders for offerings under a certain size. Okay. Number 7. Wendy,
say something?
Go ahead. Yeah,
Marsha,
sure.
can I say something?
Yeah, sure.
I struggle with locking into dollars. I'd rather lock it into other provisions, meaning we're talking about this 5 years later. We're going to come up with a number. I don't know how long it's going to take, and then it's going to be outdated. So I struggle with a hard dollar amount. And I just want to go back to 3 as well. I struggle there with, I think we need to clarify what we mean by fees, because fees can come in a lot of different ways. It can be a fixed fee. It can be a percentage fee. It can be something later. I don't know how that's going to be meaningful at the level that we're talking about. I just want to throw that out there.
I hear you. And remember that this is a recommendation that then the commission would take to look at on another level. So, we're just basically saying that there should be disclosure of the fees charged, regardless of what those fees are.
Okay. I get it.
Thank you. Okay, so we're good with the blanket exemption for finders for offerings under a certain size. So we're not giving a size, we're basically saying under a certain size. Okay. And Herbert, go ahead.
Yeah, just a quick comment. I'm languishing in the zone where Wendy was a little bit. The disclosure piece, I think you explained it, but the blanket exemption under a certain amount, we've done some work in the past where we recommended amounts or we represented some, I guess, narrow corridors with this work, but we sort of underscored it with subject to review every 3 to 5 years or whatever that is. I am struggling with just saying blanket amount under a certain amount and not giving an amount. And I think Rose alluded to it earlier. 100 million seems to be the top end for me. If it's under 100 million, subject to approval every 3 to 5 years, I'd ask the committee to consider some sort of language like that.
You mean around the certain size?
Yes, if we're saying blanket exemption under a certain amount, what is that amount? Blanket exemption under 100 million, 50 million.
Okay. So what does the committee think about the size there? Would we say under 100 million? Under 50 million? We've had this conversation before at the committee where we don't like throwing numbers just randomly. So if there'd be like, and to Wendy's point, like by the time this could go into effect, it could be years from now and it would be irrelevant. So I think maybe having it a little more vague right now is okay. And then as it starts to get honed in, I think the commission would be able to take a look at that at the time. Does that make sense?
I think with that, Marcia.
Yeah. Claire.
Thank you. I understand the committee may feel differently about this, but the small dollar offerings that we see are enforcement actions and are not restricted just to those over a certain amount of money. They do include smaller dollar offerings, including ones even as small as tens of thousands of dollars all the way up to just a couple of million. A more tailored regime to allow for some of those regulatory burdens to address some of the concerns about costs may be more beneficial than limiting it to merely just a blanket exemption for under a certain dollar offering.
Well, I think to be clear, the prior recommendation was not a blanket exemption that there's nothing within the finder's framework that they would have to give notice for. This was a blanket exemption from broker dealer registration, so long as you complied with, the principled framework around what a finder is in this recommendation. So we're not saying that anyone can go ahead and, this is part of the problem, right? Right now, anyone can make an introduction and have a side deal that they're going to get paid on a percentage of the raise, and there's no clarity on, if that's allowed or not, right? And then something goes sideways and it comes to you for an enforcement action, right? So I think, in the recommendation before, it was finders with the capital F, right? So this is if you're a finder and you're operating under this size, right? Within that finder framework, you do not have to be registered as a broker dealer. If you were to go above that, right, to do the activities that you want to do as a finder, which a defining one from the last conversation was that percentage compensation, you would need to be registered, go through the full process pathway for a broker dealer. So we're not saying you're totally exempt from everything.
That's right.
Thank you. I appreciate the clarification.
And I think that goes to point 7 on the document from November of 2020 is that it says the commission should consider the issue of fees to finders, including reasonableness around finders' fees and or limits on the amount of the finder's fees. So that's what we were basically just talking about. And I do think that we have kind of covered that through number 3. Here, yes, it needs to be considered that there are whatever the fees that are being charged need to be considered. We're not necessarily giving any limits here at this point. Would we agree there? Yes. Okay. And then the commission should add clarity on prohibited and permissible activities. I think we kind of covered that already as well. For example, contract restrictions being at one time a year. And at the committee back in 2020 had talked about this natural person requirement. We did not talk about that too much. We talked about it a tiny bit in the July meeting. I think we all agreed that we were talking about people, not entities or AI bots or things like that. Correct? Yes. Okay. And then the last thing that was on there, recommendation on number 9 from November 2020, had to do with, again, tier 2. We're not talking about tier 1 and tier 2 anymore. We're just talking about finders in general. But this was about whether broker dealers are allowed to pay finders that are non-associated persons. So I don't know if we want to weigh in on that at this point or not. Anybody?
Well, at least sort of honing in on the tier 2 component of that statement. I think, one of the things we talked about today was sort of getting away from the tier 1, tier 2 aspect of it. So at least with regard to that clarification, this one probably doesn't roll forward in the same way that all the other ones did.
Right. Okay. So we just went over the 8 of the 9. We're going to take off number 9. So Courtney, could we have the voting members vote? First of all, let me ask, is there anybody who's abstaining from voting today who is a voting member? Nobody. Okay. Courtney, how do we go?
I think we just ask folks to raise their hand with the vote you're looking, or the recommendation you're looking to have voted on. And then TJ and I will tally for you.
So essentially those 8 things that I just read that we were all agreeing on, that is what we would be putting forward as a recommendation to the commission. So if we could vote on those as a collective, and everybody who would vote yes, please raise your hand, and you can raise your little golden mitt also.
Courtney, if you're talking to us, we can't hear you.
Sorry about that. Thanks, Herbert. I noticed that. TJ, I'm counting 11. What about you?
Yes. Yep.
Okay.
Super. Thank you, everybody. You can put our golden mitt down now. Great. What robust discussion. Does anybody else have a comment or a question before we break for lunch and go into our very robust afternoon discussion?
No, I think this has been great, and I'm going to have to hop off actually, but the only caveat, and I know this is bad form to do this after the vote, but I do think inserting some clarifying language into number 6, saying where it says commission should consider a blanket exemption for finders under a certain size. I think some of Rose's language, just clarifying that statement would be helpful.
Great. We can go back and look at the transcript before, as things are getting actually written up. Herbert, do you have your hand up? Herbert, were you talking?
He's saying no, Marcia.
Oh, okay. Okay. So are there other parts then that we want to be voting on related to finders? I was of the impression we were putting together the things from the past and maybe clarifying.
So I mean, looking at the transcript in our last discussion in July, I think we did have a couple areas where we went a little bit further than the November 2020, principles-based guidance, but these were still framework-based, not with limits. Marcia, if I may, I'll just read some of these and then we can come back and decide if we do have alignment on them that we want to take a vote to add to the recommendation from November 2020. So the first was that we believe finders play an important role in facilitating the flow of capital to small and emerging businesses, and that current regulations discourage finder activity. So again, I think the prior recommendation presupposed this, and it might be helpful for the commission to hear that this is both important and the ambiguity right now is in fact discouraging the behavior, which is hurting capital formation for small businesses. So Marcia, if we want to take a pause and vote to see if we have consensus around that.
Okay, let's do that. If everybody wants to raise their hand.
I'm also at 11. TJ?
That's the same.
Great.
All right. And then picking up from where Rose left off, the other thing that we had talked about was that the committee believes there is a strong need for regulatory clarity to distinguish finder activity from broker-dealer services, and that a limited exemption from broker-dealer regulations for finders who assist companies should be adopted. We get a vote on that.
Same, 11. Thank you, guys. So a bit slower when we're counting between screens.
Yeah, it's kind of hard. Okay. Mitts down. Next, the committee believes that federal preemption of state regulations should be considered when evaluating the effectiveness of any potential regulations or exemptions.
I'm at 11 again.
Okay. The committee believes the past SEC proposal non-finalized rulemaking limiting a finder's ability to contact investors or provide any commentary on the terms of investment were overly restricted, and any regulation that gets reproposed should permit finders to communicate with potential investors about the nature of the company and the terms of the financing. So I think here we just did talk about the fact that we wanted to make sure that people were helping with certain things, but not necessarily making a recommendation. Vote on that.
See 11 votes in favor again.
Perfect. Okay. The committee believes that regulations requiring disclosure of the identity of any finders fees paid to finders, and any relationship between the finder or the issuer or other investors should be appropriate, if not overly burdensome.
Here I'm getting 10. TJ?
Done.
Oh, 11. Diego up now. Thank you.
Okay, just 2 more to discuss. The committee believes that any registration process that finders are required to comply with should be minimal and be open to non-professional participants to complete without needing assistance from professional advisors. So basically, again, I think this goes back to the first thing that we talked about from the 2020 recommendation, which was to keep it simple. Vote on that.
I see 10. Rose, could you clarify if you have voted on this?
Oh, she's not voting
Thank
on.
you.
I was voting no for that. Okay.
That is 10 yes.
And then the committee believes that regulations requiring oversight of or responsibility for finder activity by issuers could be appropriate if not overly burdensome.
I see 9 in favor. TJ, can you confirm?
10.
You are right. 10. Thank you.
Okay, great. Well, thank you, everyone. Courtney, are we good with all the voting?
Yes, ma'am.
Okay, great. Thank you for all that. Lots of great discussion today. Really appreciate everyone for sharing their perspectives and helping to bring these conversations to the committee. And for those of you watching on sec.gov, the committee will return at 1 p.m. Eastern time after a short lunch break. Thank you all for tuning in and look forward to having you back in a little more than an hour from now. So, and same to all the committee members, if you are taking a break, make sure your microphone and video are off. See you in an hour.